the technicals coming in, but let's concentrate on a couple of numbers. IDFC FIRST Bank is higher on trade. This is on the back of their Q1 numbers. To discuss the earnings fine print and the outlook going ahead, we have with us Vaidyanathan, the MD and CEO, joining in. Mr. Vaidyanathan, hi, welcome to the show. I wanted to start by asking you about your net interest margins this quarter. There has been a decline which has taken place on a sequential basis. It's coming at around 5.89 versus 6.3% or 6.2% in the previous quarter. What took place? What's the guidance?
Last quarter, as you know, the interest rates in the system went up, repo rates went up by about 90 odd basis points. We've not yet passed on those rates to the customers this quarter. The last quarter. So this quarter we'll be passing it on. So our margins will readjust back to about 6% again.
Okay, Mr. Vaidyanathan, good morning. I also wanted to ask you a little more on the same point. How much of your book is linked to external benchmarks? Is any of it linked to repo at all?
Yeah, about 38%.
Okay, so that didn't help you in the quarter gone by, because after all there was a rise in repo rate.
So we didn't pass it on last quarter because we have a policy of passing on with a lag. So this quarter we'll be passing it on, and then the margins readjust back to about 6%.
Okay, was there a rise in? How did the deposit costs behave?
Went up by about maybe 27 basis points.
You expect that to eat up margins? You expect to see that trend continue?
That's why you saw the net interest margin come down.
Yes.
Because as you know, the repo rate, once you pass it on, that will correct itself.
Okay. No, my simple point is that the rising interest rate scenario cycle is impacting your deposit costs, but is not giving you a gain in terms of higher returns from your loans. Why is that mismatch? For other banks, it is working the other way around.
I know other banks passed on when RBI, many loans are linked to.
I got your point. Yeah.
So let me slow down the explanation. So other banks quickly passed it on to customers. We are passing with a lag. So on the floating rate portfolio that we have not yet passed on. That's what I was trying to explain.
No, I got that. So I'm just wondering, why is that? Why is that the cost is hitting you, but the gain you're not assuming, passing on the gain immediately? Why this lag? And will you get back to 6.3?
I can't say 6.3, but certainly around 6% we feel quite comfortable with. See, Lata, there are two things. One is on incremental loans, one is on stock. On stock basis, we have not yet passed on, which we will do soon. On incremental basis, we play by the year depending on market conditions. But our sense is that we will pass on even incremental interest rate to customers during this quarter. So our margins, frankly, Lata, we are not very worried about whether you call it 6 or 6.1 or 5.9. They're all in the pretty good zone actually. So.
No, I agree, but it's a good 40 basis difference from the 6.27 to what you have produced, and
so we will pass it on, Lata. Okay. So to keep simple short answer, we will pass it on soon.
Okay.
And the margins should normalize.
Okay. Well, just a word on a macro number that is coming coming in on the PMI front, and remember this is PMI manufacturing. Lately, we have been doing far better on PMI services. If manufacturing itself has shown a good 3-point increase over the previous month, or 2.5 to be precise. That augurs extremely well for all the growth numbers that will come from July. So that's a positive, of course, for banking as well. Mr. Vaidyanathan, the other thing one could crib about a bit about your results is the fee income. Any particular reason why it fell, and how do you expect to see that? How do you see the trajectory in the current and next quarter?
See, our fee income actually went up quite strongly. Actually, if you take a year on year. But that's also because last year, the base effect because of COVID second wave, there was not much action. So YOY fee income, core fee income has gone up by 100%, Lata, just to put that number in context. So I don't know if you're looking at
we're looking at quarter on quarter, but I thought even YOY it was not impressive. But anyway, the quarter on quarter decline is very obvious.
Year on year is certainly a 100% increase. So thing is that we feel very good about the fee income. Because there are a lot of engines we are still not fired. For example, we are not doing a great job at cross-sell yet from the branches. We, selling of mutual funds, insurance, etc. That machine just started for us. We started wealth management business that grew up like 90% plus last year. We expected to compound again by 90% next year. So that will give fee income. Credit card business is growing really well for us. That has a lot of fee income. So these are all new engines we started, and all of them will bring in on a fee income for the bank. So I'm not very concerned, and you should not be very concerned either.
Okay. Well, if you can give us some idea of loan growth then, what will fire in terms of bringing the numbers, and how much of an advances growth are you expecting?
On the loan front, as you know, Lata, last 3 years we have not grown the loan book at all. It's like 6% compounded. But you know the reason for that, because we wanted deposits first. Loans can always come later. But now onwards, we think that for us to grow the loan book at about between 20 to 25% compounded from here, year on year for many years, you should expect from us.
Okay, and which would be the verticals that will fire?
See, the retail, home loans, car loans, personal credit, vehicle financing, all the usual stuff. India is growing and it will keep growing. I don't see us this stopping for the next 15, 20, 30 years. So that is firing, and whether short term, long run, everything will keep going up. The second one is, of course, the other business we have launched. We launched cash management, we launched wealth management, we launched fast track, all that. They'll all keep growing, Lata. So I honestly, I don't think that growing a loan book in this country is difficult at all. It was very conscious for us not to grow it. But now, like I said, all these machines are firing well. Okay. I mean, ours is a pretty stable state. It's like you can count on it to just keep compounding from here. I don't see any problem. Okay.
And the big question that I guess all investors are always asking you, what is the latest on the merger with IDFC and IDFC Bank? Is it happening this year?
Well, the thing is that we are keen, and IDFC Limited is also keen, since those are announced to the exchanges. I think they are going through their own procedural issues because of the couple of companies they have and the mutual fund entities have. I think it's all procedural at this point of time.
Okay, so
that's our sense broadly.
I know if I had the IDFC management, I would have asked them as well. I know, but still FY23 should be penciled in.
I can't put in a number at all. Okay. A lot of procedural things have to be done. We have not even started talking value and all that. So, okay. Let's play it as it comes. But broadly, let me say that in spirit, things are moving ahead. In spirit.
Oh, right. Okay, thank you very much, Mr. Vaidyanathan. Results season, so a lot of results lined up. We'll have a more detailed chat later. Thank you very much for joining us.
No, before we sign off, Lata, since you asked a lot of questions, let me give one guidance. I think last 3 years, every single guidance given by the bank, I'm very proud it's coming through. We guided CASA. In fact, you harassed me a lot on CASA, whether we'll ever grow it, but that's come well. Loan growth, the retail one, everything, our pre-provisioning operating profit, every number's come well. Let me make one further guidance now.
Sure.
One of the key items that we came across last year, you may have missed the point, is that our return on assets, starting from a zero base literally 3 years ago, has now touched 1%. It's a pretty quick catch up, and our own internal assessment is that it will now touch 2%. Let me say that's the next stop we're going for. Return on assets at 2-ish will be probably very healthy, but we feel we're definitely getting.
Mr. Vaidyanathan, I normally play the tape before you come, and I remember you talking about 1%. You're talking about 2% now. Give us a time frame as well for that.
Our business model is fundamentally structured for that. The way the NIMs are, credit costs are, everything is structured for that. It will happen, I mean, in due course, and you watch it quarter on quarter. My sense is that you will not be disappointed from here on.
Okay, but in any case, 1% itself is very, very creditable. Many congratulations. Thank you very much for joining us, Mr. Vaidyanathan.
All right, Mr. Vaidyanathan as well as Lata. Thanks very much for joining in. So an ROA timeline for round 2.